Now the next topic is fundamental accounting assumptions. Fundamental accounting assumptions. In the first year of accounting, usually students learn about the fundamental accounting assumptions and the accounting policies and all these things. So there are basically three fundamental accounting assumptions. The first one is the going concern, the second one is the accrual, and the third one is the consistency. So these are the three fundamental accounting assumptions. Let's start with going concern. So as the name suggests that going concern represents some continuation of something. So financial statements are usually prepared on the assumption that an enterprise will continue in operation in foreseeable future, and neither there is any intention nor there is need to materially curtail the scale of operations. So this is an assumption while preparing the financial statement. It is always in the back of mind that the business will sustain for a foreseeable period, for a certain period of time, and there is no intention to close down the business, because if there is any intention to close down the business, then definitely you have to make the provision for that, which nobody does. So this going concern is a basic assumption which is always there while preparing the financial statement. So this is the first assumption. Now the second one is accrual basis. So the transactions are recognized as soon as they occur, whether or not cash or cash equivalent is actually received or not. So accrual concept says that whether you have received cash or not, or whether you have paid cash or not for your income or expenses respectively, so you book the expense or you book the income as and when it accrues. For example, if suppose you owe to bank some interest amount on your personal loan, it is possible that you pay interest after every 1 year. Say the interest was due on 31st of March 2015, but you are paying interest to the bank on say 1st of April 2015. While preparing the balance sheet and profit and loss account for the year ended 31st March 2015, you have to book that interest expense into your books for the year ended 31st March 2015. Although you are paying cash after the year end, but that does not matter while accounting the interest expense. So accrual basis says that whether you have received cash or not, or whether you have paid it or not, it doesn't matter. The expense and the income should be booked as and when they are accrued. So accrual concept actually ensure a better matching between the revenue and cost, and the profit and loss obtained on this basis reflect the activities of the enterprise during an accounting period rather than cash flow generated by it, which is very true. Hence, the accrual basis is the more logical approach for profit determination as compared to cash basis of accounting. See, cash basis of accounting, you actually book the expense and you actually book the income when you actually receive the cash, which does not give you a correct picture. So accrual basis is the most logical approach for profit determination. Now the third fundamental accounting assumption is consistency. Consistency of what? Consistency of accounting policies. So this assumption says that if you are using an accounting policy for a similar transaction, then you should continue that accounting policy for all the accounting period, because the consistency improves the comparability of the financial statement throughout the time, and the accounting policy should not be changed unless or until it is required by the statute or by the accounting standard, or the accounting policy is required to be changed to give more appropriate presentation of financial statement. Unless or until any of the three reasons is there, the accounting policy should continue for all the accounting period. So these are the fundamental accounting assumptions. So these are always the assumptions while preparing the financial statement. So while preparing the financial statement, no one will write that the company is going concern or it is following consistently the same accounting policies, or the company is following the accrual basis of accounting. So you will not find these things written in the notes or the schedules in the financial statement, because these are the assumptions. Unless or until any of these three assumptions is not there in the financial statement, or the financial statement fails to follow any of the accounting assumption, then only the company has to mention that separately, that this particular accounting assumption has not been followed while preparing the financial statement. If nothing is mentioned in the financial statement, then it is assumed that all these fundamental accounting assumptions has been adopted as it is. So these are the basic fundamental of the accounting assumptions.